All right, Susmit Patodia is joining us now to discuss markets. Susmit, what did you make of this, nice little correction which actually happened in the broader markets last 8-10 sessions? Got accelerated yesterday, but at the same time got arrested in the second half, and now, of course, building back. Do you think the froth is out now?
Hi, good afternoon. I think a market correction of 3 to 4% is not really worthy of being called a correction or the froth being out. I think whether it be related to BSE surveillance circular, or I think the stream of IPOs that we've had and the great listing, a small amount of 2-3% should not be called a correction. I think it's just an adjustment that happened.
Fair point. In fact, on the index level, surely it appeared small, but if you look at the large parts of small and mid caps, they got reasonably, corrected. I would say the upper circuit range, all of that got stalled, and whatever the trigger might be. Where in this market are you witnessing highest margin of safety versus earnings acceleration which lies ahead in coming quarters?
So we continue to believe that vaccination is the way out of this pandemic, and as we pick up our vaccination drive over the next couple of months, we should see a normal economy coming back. We may still have COVID appropriate behavior with respect to masks, but businesses should be normal by Diwali this year, hopefully. And if that happens, then sectors which are geared towards physicality of either goods or services should do much better and will have a lot of margin of safety and earnings momentum ahead than what has happened in the last 12 to 24 months. So whether it be malls, the auto sector, you take your pick, anything which would involve physicality of an individual should have much better prospects in the next few months or quarters.
Susmit, I was just looking at the commentary coming from Siemens this time, regarding the demand environment, the orders, etc., and the kind of discussion they're having with their clients. Siemens being one of the sector leaders in that space, automation, capital goods type. What are your thoughts on that space? Because in many areas, this is like a leading indicator. They do work with so many different sectors and companies across in the country. What are your thoughts on this space? Not on the stock, but the space?
So I think, Siemens, you take up any capital goods or lead capital goods play, as you rightly said, one of them being Siemens. You can talk about any of the other companies in this space. Most of them are seeing enquiries and order books not seen in the last decade, right? And again, this is not surprising. If you look at the typical capex cycle of our country, or for that matter, any country, you go through this, huge capacity buildup that happened in India from, let's say, 2002 to 2010. And then you have a correction phase. And correction phase actually ends very interestingly with the cleanup of the credit cycle, right? And that's what has happened over the last, I would say, 4 years in India since Dr. Rajan initiated the AQR, and we've been in a cleanup phase of the credit cycle. The last 2-3 quarters, you look at any corporate bank's results, you know that the credit cycle is behind, and now you will have the build-up phase of capex. So this is exactly what happened from 97 to 2002. You had a big NPA issue in Indian banking system. You had that cleaned up, and post which you had a big capex boom. Pretty much the same cycle playing out. Very, very bullish on the capex cycle going ahead. Obviously, the texture and the feel will be very different from the last cycle, where you had hydrocarbon, metals, and cement nearly make up 50 to 60% of the capex cycle. We think this time it could be housing, infrastructure, which is more like roads, railways, bridges, metros, which could do the heavy lifting for the capex cycle.
Housing, clearly, in fact, commentary from most real estate companies does indicate very robust pre-sales. But if one were to really break down the entire real estate space in southern India-based companies, be it Western companies, Mumbai, Pune belt or NCR, do you have any preference on which side appear to be in better shape on earnings versus valuation parameter?
So, frankly, real estate is actually a very, very localized industry. You may have a national brand, but typically we have seen, and this is, you look at Hong Kong, US, some of the large London, some of the large markets, most of the developers are regional in their play. You will find very, very few pan-country players, especially in the residential sector. Now, within that, I think the Western region in India, especially MMR, looks very, very interesting, primarily because the prices haven't gone anywhere for 8 years, while incomes have gone up 7-8% CAGR. In fact, if you look at HDFC's presentation, they say that the affordability index of housing in India is nearly at a 20-year high. So, economic prosperity is concentrated in Bombay and Pune, and also the demand for houses is the most in these cities. So, most bullish on the West. Second, I would say is the IT belt, which would be Hyderabad, Bangalore. Apologies. And the third would be NCR. So I think this is how the residential stacks up. Just to give you a factoid here, about 8-10 years ago, as a country, we used to sell 5.5 lakh new houses. Today, that number is down to 2.5 lakh houses. So in a country of nearly 25 to 30 crore families, all that we sell is 2.5 lakh houses a year. So long way to go.
Fair point. What about banks? When you look at the numbers and also the commentary from private sector banks, the laggards like HDFC Bank, Kotak have just started coming back. For the 1 year almost they did not move, and the focus of the market was ICICI, SBI category, Axis, all of that. How are you looking at this entire space, private sector banks?
So interestingly, Ajay, the yesteryear retail banks have become today's corporate banks, and the yesteryear corporate banks have become retail banks, right? So if you look at HDFC Bank, now the majority of the loan book is in corporate. If you look at SBI, majority of the loan book is retail. So it's kind of a funny transition that's happened over the last few years. Having said that, in the last 1 year, in some of the banks that have done well, as you name them, primarily because they did not show credit cost that people had anticipated. Unfortunately, irrespective of what bank you are, you have not had credit growth. So I think whenever credit growth comes back, most of the banks in India should do well. Our credit growth for the last 6 years has been 6% CAGR, and if you believe what Siemens says, if you believe what other corporates say, and if you believe housing is going to come back, this credit growth number could go back to 12 to 15% very soon. And if that happens, then almost all banks do very well. The other interesting thing is inflation, which is, whenever you have an inflationary cycle, your working capital requirement goes up. And when that happens, you automatically have credit growth as well. So, I would say inflation, working capital cycle, and corporate capex ticking up, all this put together should lend very, very strong credit growth into the system over the next 3-4 years. And you have a very, very clean credit backlog book to run with. So very little hangover from any of the last crisis, and big credit demand ahead.
Right. All right, Susmit, we'll let you go on that one. Thanks so much for joining us on the show today.
Thank you.
With that, it's a wrap on the show. Thanks very much for watching. Goodbye.